Futures are higher this morning, up a little bit, but maybe getting back half of Friday's drop. Treasury yields fell significantly to end the week. That was definitely eye-opening. Kelsey Berro is fixed income portfolio manager at JPMorgan Asset Management. You were okay this week. I mean, you didn't lose any sleep. I'm reading your notes. You're like, there's some interesting things happening, but not really not that earth-shattering. You point out that the last time that you had a labor market at a similar crossroads, the Fed went 50 basis points in September of 2024.
Right.
However, we're already 100 basis points lower than we were then. And in your view, the labor market is moderating, but no signs of an imminent recession or anything that serious yet.
Right. Yeah, so the labor market is moderating. The revisions were a shock to the market. So you saw the market pull forward the probability of a rate cut in September from less than 50% after Chair Powell's press conference to more than 90% probability of a rate cut in September now. And my key message, when you're looking at the data is when we look at this data, one of the things that you need to focus on is the fact that you can't just choose one data point to look at, one data series to look at. Revisions are always going to be part of the process, but look at a variety of data points. What are they saying? Are they all pointing in the same direction? Earlier, I heard Andrew mention ADP. Yes, ADP and NFP tend to go in somewhat different directions from month to month, but look at the 3-month moving average for ADP. It shows job growth of 37,000. Compare that to NFP, which shows job growth of 35,000. They're both essentially telling you the same picture, which is labor demand is slowing. And ultimately, we do think that the Fed is going to deliver additional rate cuts later this year as a result.
How many? And do you think a 50 is on the table?
I don't think a 50 is on the table right now. But of course, it depends on how the data flow evolves. If we were to see additional data points that suggest that job growth is slowing at the same pace it is right now and continues, and you see an increase in the unemployment rate or an increase in unemployment claims, which have remained very, very low, those would be signals that the Fed needs to start moving more quickly. But one of the key data points that Chair Powell emphasized at the press conference was the fact that the unemployment rate isn't rising this time. And that is a difference from now versus September of 2024.
But maybe not for great reason. I mean, more people are leaving the workforce? Or?
Correct. I mean, it's not necessarily a good thing that job growth is slowing, even if the unemployment rate is staying in the same. And that's why the market reacted the way that it did. It didn't look at the unemployment rate and say, the bond market. It didn't look at the unemployment rate and say 4.2%, oh, we're okay. It actually said, all right, I'm looking at a number of different data points, and they're all kind of pointing in the same direction.
I think it's 4.25, too, isn't it?
It is 4.25. So if you look at it on an unrounded basis, it's 4.248, which is the high water mark of the cycle.
If it had been 4.25, would it have been rounded up?
Yes, it would have been rounded up.
Okay.
And
so
yeah,
4.248. Okay.
I mean, these are all optics.
No,
right?
I know we love minutia, and you point out that you think that the Fed. See, my criticism was if they really are data dependent, and you looked at the data for the last 4 months, you would have probably eased because inflation, the data wasn't there. The data for the job market was there. At least you would have had a bias towards that. And you say they did have an easing bias.
Yeah, so
already.
I do think that they still have an easing bias.
What does that mean? The way they sit differently? Or what kind of, they didn't do anything?
Well,
how do they have an easing bias? What does that entail?
A couple things. One is if you look at the dot plot or the summary of economic projections and their forecasts, the majority of the participants do see 1 or 2 or 3 cuts this year. So within their own forecasts, they are projecting rate cuts. And I also look at it in terms of the bias. What is the higher hurdle rate? Is it higher hurdle to hike rates or to cut rates? I see it as a very high hurdle rate for them to turn around and to start looking at cutting rates relative to the data that they would need to see to start easing rates again after the last 7 months of being on hold.
How's the yield curve look? It looked okay to me in terms of course, last time it was inverted, there was no recession anyway, was there? But we're nowhere near an inversion. So the bills in the 10-year are about the same,
yes,
aren't they? What's that mean?
The bills in the 10-year are about the same. Other points in the curve have more clearly steepened and are no longer inverted, which is actually a much more healthy environment for a fixed income investor. So typically the debate is, why would I take duration risk? Why shouldn't I just stay in cash? Exactly. Cash is yielding around 4% right now. But if you look at a core high-quality fixed income portfolio that can yield you around 5% and also give you downside protection in the event of a jobs report like we got last Friday, that's the risk reward that the fixed income part of your portfolio has in terms of diversification.